absolutely in a stock market bubble. Absolutely. There's so much bubble behavior in so many things, actually. Crypto, stocks, all these high-end, even with major hype stocks down 70, 80, 90% or more in the last year, we still have a very high bubble. What has driven that? Low interest rates. I think that's a big driver of stock overvaluation. Why? Because as interest rates fall, you're getting a crappier return on your money by putting it in the bank or putting it with treasuries. So when you see the S&P a few years back paying 2.2, 2.3% dividend, your comment would be, why should I put my money in the bank and get 0.1 or 0.5% interest? I might as well put it in the stock market. I'll get 2.2, 2.3% interest. That's the theory behind it. But what people don't remember is that drives up prices. That's why you've seen the dividend yield on the stock market fall in half. So what does that mean for the future? Well, guys, I'm a value investor. I'm Paul. So if you're new to the channel, my goal is to look at the numbers of companies in the markets and make determinations on if I'm a buyer or a seller of stock. That's what I do. From there, I then determine what stocks to buy based on those quantitative aspects and then pulling in more qualitative parts of the company. Which ones are in businesses I like? Which ones have good management, etc. I'm looking at those things from a long-term perspective. I don't make my decisions on quarter to quarter or year to year results. I try to find good businesses at great prices that I can own for longer periods of time. Is that easy? No. Is it simple? Yes. It's simple, not easy. My goal here is to be very patient. That's a very tough thing to do when everyone around you and all these 18-year-old kids are making lots of money buying hype stocks and hype assets. But I do believe that right now, we are in a stock market bubble, and there are three things I look at to show that. So, first things first. The 10-year cyclically adjusted PE ratio. What does that mean? What this does is it ignores year-to-year fluctuations in earnings of the stock market. It takes the last 10 years of earnings in the stock market, brings it all to today using inflation, and then divides the current stock market price by that to give a more of a 10-year PE. We do something similar in our software. We look at a 5-year PE for individual stocks. But at a 10-year PE, historical average is 15 to 16. We're currently at around 31 or so, maybe 30, about double. That's pretty bad. So what this says is, stock market, if it fell in half today, would be at historical averages. That's pretty scary, right? Of course. But over time, fundamentals can get better, but it's much easier for prices to fall. That's our first metric. Our second metric, the price to sales ratio on the stock market. What this does is it takes the entire price or market cap of the stock market and divides it by the sales, the revenue of the entire stock market. And historically, the average is 1. Now, that's historically. Remember, nowadays we have more service-oriented businesses that have higher price to sales ratios. But does that mean it doubles? No. And the current price to sales ratio on the stock market is around 2.5. So even if this one becomes 1.3 or 1.5 based on the new businesses, we're still looking at almost double the current value. So 2 of my 3 metrics already show that the stock market based on historical levels is about double where it should be. That's pretty scary. Now, the final metric, and this is called the Buffett indicator, because Warren Buffett made this famous by saying at any given moment, this metric basically tells you where we stand in stock market with a reasonable accuracy. It is the stock market to GDP ratio. So the idea here is that the GDP of a company should drive overall business value. So you take the stock market's value and divide it by GDP. Historically, if you're around 80% or so, you're going to do pretty well in stock. It's a little bit lower, maybe a little bit about where it should be. We're currently at 160%. So again, we need to fall in half. So the 3 most reliable metrics, 3 of probably the top 5 most reliable metrics in stock market valuation are all saying that stocks have to fall in half. So what does that mean for the next 10 or 12 years? Well, guys, this is the scary part. Right now, including dividends, the stock market, based on those numbers, should return 0 to 2% a year over the next 10 years, including dividends. Now, is it possible that it's wrong and it's different this time? It's possible. Is it probable? I don't think so. And that's a big thing that drives my investment decisions. Is something possible? Yes or no? But is it probable? We are poker players. We are here to make calculated bets. We are going to be wrong some of the time. Just like if you have pocket aces in poker, you're not going to win every single hand. You're going to win good hands, but you're going to lose along the way some of your hands. Same thing with stocks. So my goal as a stock market investor, as time goes on, is this. This is my personal goal. That's where stocks go. This is where stock prices happen. This is the value over time. This is what happens. Your goal as an investor is the dollar cost average. It doesn't matter where you're at. Save the same amount of money every single time. Why? Because you don't know what's going to happen. Schwab did a study recently, and we did the same study internally, but we went a little bit further. Schwab did a 20-year study. We did a 30-year study. The 30-year study looked at returns based on dollar cost averaging or being a perfect timer. And guess what? If you were a perfect timer, you bought at absolutely the lowest point every single year versus dollar cost averaging, your return over 30 years the difference was negligible. About 0.5% per year or so, give or take. I don't remember the exact data, but it was so small. So why have the stress of having to pick the best time every single year? And that's only if you pick the best moment, the lowest price every single year. Instead, you overpay sometimes, underpay sometimes, but overall, this is what you're paying. That is the key here. That is your goal as an investor. And this is what usually happens. People usually buy here and they sell here because human nature gets FOMO here. I can't miss out, and gets here scared. Oh my God, stocks are going to zero. That's human nature. We all do it in some. I have the same issues. When stocks that I pick go down, I go, am I wrong on this one? And unfortunately, when stocks I pick that go up, sometimes I don't question them as much as I should. That's human nature. Your goal is to take emotion out of it and dollar cost average. Does that mean you shouldn't pick individual stocks? No, of course not. It's fun to pick individual stocks, but learn a process. That's why you're watching this video. That's why we do 3 or 4 videos a day on this channel. That's why we have 160, 170,000 subscribers. We do individual analysis and we look at a process for how you pick individual companies, but you shouldn't put the majority of your money in individual companies. Low cost ETFs, dollar cost average, and you will crush it in the long run. There are other studies that show that people who try to do this end up making 4 to 6% less per year than the market. You are getting crushed by trying to use your emotion to buy at the right time. It will not work. Trust me on this one. It will not work. But if you like the idea of looking at companies individually and using our 8-pillar process to understand what to look for in companies, you can do well on a portion of your money. Take 10 or 20% of it and buy individual companies. But even then, buy a basket of diversified businesses selling at good prices. If you use that right process, you will do well. Don't waste your money with a financial planner who's just going to put you in mutual funds that don't beat the market over long periods of time. It does not work. You get feed to death. And especially when stocks are going down, if you put money in stocks and they go down and you're being charged 0.5% or 1% a year, you're going to hate it. Go buy a low-cost ETF. Save your money and just know that wherever the stock market goes, that's where you're going. There's no reason to try to beat the market in that regard. It ain't going to work. But you can find a process that you take a portion of your money at and go buy individual companies at great prices and hold on to them for long periods of time, and you will probably do quite well if you stick to that process. If you like the idea of learning more about our 8-pillar process, click on this next video where we explain it in more detail, and don't forget to subscribe to our channel. Thank you very much for your time.